It's been said that the best investment on earth is earth. I'm talking about real estate, and I'm going to tell you in this video why I think real estate is the best investment class out there. So what makes real estate unique as compared to stocks, bonds, crypto, gold, or just burying your money in the backyard? Well, it really boils down to 5 key factors, and they are the I.D.E.A.L factors. What are the I.D.E.A.L factors? Well, it stands for income, depreciation, equity, appreciation, and leverage. No other asset class has all 5 of those going for it. So let's break it down exactly. Now, income. This is pretty obvious. It's rents from your real estate. Now, I'm involved in multifamily investing, which is apartment buying. So when tenants rent the apartment, they of course pay rent on a monthly basis. Now, we have certain expenses to keep up the apartment, such as landscaping, paying the managers, paying for utilities, doing all of those upkeep items. But at the end of the day, because they pay rent and all those expenses are less than rent, we're going to be cash flowing every single month. This is the income piece. I don't have to wait until we sell the investment in order to get a return on my investment. And at the end of the day, who doesn't like monthly checks? So that's income. It's pretty easy to understand. Now, what is D, depreciation? Well, depreciation is kind of a fictitious fruity little IRS kind of made up nonsense. Okay, well, it's not exactly like that. Depreciation is a loss you can get on the amount of improvements on your land that the IRS allows you to deduct off of your income. Now, how could a loss be good for building wealth? Well, here's how. Because this loss is a paper loss, it's not actual cash loss, the IRS allows you to deduct that off of your income return. The IRS says you built this building on this land. This building is going to be worth less over time. The land isn't, so you're not able to depreciate any of the land. You're only able to depreciate the building, and you're able to do this amount of depreciation every single year. Now, at a high level, that amount of depreciation is typically around the amount of money that you're actually making in cash flow. So what does that mean? It means you don't pay taxes on that income from your property a lot of times because you're able to write off your loss over here against your real cash income. Now, it's a little more complicated than that, and you're eventually going to have to pay the taxes, but you're able to defer your taxation, which means the cash flow that you're getting today is going to be even better than cash flow that you would receive from other investments like stocks, which you have to pay taxes on right away. So we got I and D. Now, what is E? Well, this is equity buildup. This is something that everybody knows, especially those who own a home. Every single month, we pay down the principal on the mortgage that we borrowed in order to buy the apartment. Paying down this mortgage every single month allows us to build up equity in the property. So the tenant is going to be paying rent, which is going to be taking care of the expenses, and it's also going to be paying the mortgage every month. Because they're paying the mortgage, that money doesn't just go away. Of course, we don't earn any money on the interest that they're paying, but they're going to be paying down some of the principal as well. This principal pay down happens every single month, every single year over time. And as a result, you're able to build up more and more equity, money that you can actually refinance or get when you sell the property just by owning the property for a long enough time. We have I.D.E.A.L. Now, what is A? Well, this is appreciation, and it is pretty intuitive. Generally speaking, prices go up over time, and the same can be said with land and real estate prices. Robert Shiller, an economist from Yale, said that basically, on average, home prices went up about with the rate of inflation over time. 3% per year is the amount of appreciation that you could more or less expect on a stabilized asset. So if you bought a property for $1 million, you could expect next year it to be worth $1,030,000. Now, of course, things change. It's all dependent on individual markets, but that is a general rule of thumb. Now, that's kind of interesting, but what's really interesting with real estate is the fact that you can actually force appreciation. And what do I mean by force appreciation? So how do we value apartments? Well, it's pretty obvious, but worth saying that it all depends on the income produced by the apartment and its location. So if an apartment produces a ton of income, I'm going to value that generally more than I would an apartment that produces less income. And if an apartment is in Rodeo Drive in the middle of Beverly Hills, well, it's going to be worth more than an apartment in, say, Kansas. No offense, Kansas. And here's where it becomes interesting. What happens if I have an apartment where the rents are not as high as I think they should be? Well, I can actually buy that apartment, increase the rents, and therefore increase the value of the apartment. The amount of money an apartment produces, known as the NOI or net operating income, is going to be the driving factor in value, along with the premium people pay for that NOI, also known as the cap rate. For those who know anything about stocks, they know that the PE ratio or price to earnings ratio is the multiple, so to speak, on the earnings of a company that you're willing to pay for in order to value the company. The same can be said with the cap rate, only in the inverse. The lower the cap rate, the higher the value of the property. So if I buy an apartment and the cap rate stays the same, but I increase the NOI, well, I've increased the value of the property. This is basically the business model that my company works on all the time. We find properties that are undervalued because their rents are not as high as they should be, or their expenses are too high. We work to manage those expenses and income in order to drive our NOI. As a result, our property becomes more and more valuable because it produces more income. Therefore, the next buyer is going to come along and be able to pay more for our property. Therefore, we have forced appreciation and increased value. This is amazing, especially when compared to stocks, which you are just beholden to whatever the board of directors and CEO and whoever else is in charge does with the company. You actually have an active step if you're a real estate investor to force the appreciation. Now, I'm not bashing stocks by any means, but I am just comparing the two. One is more hands-on versus the other, which is more passive. It's not necessarily better or worse. It really just depends on what you want as an investor. So let's put some numbers to appreciation. And I know I'm spending a lot of time on this sector of the ideal factors, but it really is kind of the key factor in making tons of money in real estate. Let's just say I have a property that has an NOI of $1 million. It makes $1 million a year, and the cap rates in that market are around 5%. Well, that property would be worth $20 million. But let's say I think the property actually can have much higher rents, and therefore I increase the NOI to $2 million, and the cap rate stayed the same in that market. Now, because the cap rate stayed the same and my NOI doubled, well, all of a sudden, the value of my property doubled. My $20 million property became a $40 million property. Now, that's exciting enough, but it gets incredibly exciting when you consider the factor that makes real estate a truly outstanding investment, and that is leverage. In real estate, just like you would if you were buying an individual home, you're able to put down a down payment and then borrow the rest. Generally, you're able to borrow $4 for every $1 you have in the property. So if I put down a 20% down payment on $1 million home, which is $200,000, I'm able to borrow $800,000 against my $200,000 of down payment. That is my leverage. So what's the big deal with leverage? Well, here's where it gets interesting. Remember the property that we talked about that had $1 million of NOI and then we doubled it to $2 million and doubled the property value? Consider if we were to borrow money to purchase that property initially. Let's say we put 20% down on that $20 million property. That would be $4 million. Now run the same scenario. We doubled the NOI on a $20 million property, but we only had $4 million into it. So the property went from $20 million to $40 million, giving us a $20 million gain on a $4 million outlay. That all of a sudden becomes incredibly interesting. That's a 5 times return, as opposed to if we were to buy it all in cash, we would merely double our money. Now, of course, leverage is not without risks, and of course, you can face margin calls if you borrow money to purchase stocks. But the interesting thing about real estate is that you don't have margin calls. By and large, when you borrow money from real estate, as long as you're making your principal payments, you're never going to be faced with a margin call on that loan. Think of it, if you have a home and you borrowed money on a 30-year mortgage, your lender is never going to call you and say, I heard that you all of a sudden are making less money this year than you did last year. Give us all of the money that we gave you to purchase the house. That never happens. In other words, real estate has non-callable leverage, and it is usually able to be had at a fixed rate for a very long period of time, and that interest rate is typically among the lowest amount of interest rate of any amount of money that you can borrow, typically 3 to 4%. That's why real estate leverage is so interesting, and lenders feel most comfortable with real estate as opposed to lending you money to borrow something else because they have a physical asset that they can take and foreclose upon in the event something horrible happened. Just think of it this way. If you were to go into the bank and ask the teller for a $1 million loan to go buy 10 Ferraris or go buy a bunch of stocks, she would just laugh at you and you would be walking out of there with no money at all. But if you go tell her that you want to borrow money in order to purchase real estate, all of a sudden you get talking. So these 5 factors, income, depreciation, equity, appreciation, and leverage, are really the things that can't be found in any other asset class like they can in real estate. Of course, real estate has risks as well. You never know what you're going to get when you purchase an apartment. And if you're doing it without the expertise, you're going to find yourself spending way more money and time than you would if you were to just purchase a simple ETF, something probably most people should do. But if you know what you're doing, real estate can be an awesome way to make money. Coupled with this is the fact that real estate is a very fragmented market. It's not a perfect market. You don't have people with all of the knowledge about every single sector in real estate at all times. You may know your neighborhood better than other people. You may know that your neighborhood can command rents that are X, and other people think that they can command rents of less than X. Therefore, you have an edge in purchasing that property versus anyone else out there. Compare that to the stock market, where all information is basically free and known by all parties at all times, where you have more or less a perfect market. You can see why real estate allows you to have arbitrage in areas where the stock market doesn't necessarily lend as many opportunities. Hopefully you could see why I'm so passionate about real estate. My wife and I have a substantial amount of our net worth tied up in real estate for the very reason that I feel that it is, on a risk-adjusted basis and really kind of on a nominal basis, one of the best investments that anyone can possibly make. I'm going to be making several more videos about real estate, giving you my in-depth thoughts on it, so subscribe to the channel if you want to see more videos like that. And if this video helped you out in any way whatsoever, just give it a simple like. I'd really appreciate you doing that. It really tells me that this is a topic that you want to see more of, so please do so. Now, if you like that sort of thing, be sure to check my other videos out, and again, subscribe to the channel. I'll see you next time. Thanks.